Good morning, this is Dave Toth with an RJO MRT technical webcast update on the energy complex and the gold market for Monday, August 8th. Starting off here with a daily log scale active continuation chart of the crude oil market. You can see the clear and present downtrend after last week's pivotal break below the 89.61 low from late June that absolutely confirms the long-term trend is down. As ominous as that sounds and may turn out to be, looking here at a weekly log scale perspective, we're trying to discern whether this past few months sell-off from the May 2nd high up at 114.83 is part of a major reversal or merely correcting the past year's portion of the secular bull trend from the May 10th low of 67.15 up to the 114.83 high. Much further weakness than we've already had, and we can make a good argument that this market is in a major reversal to the secular bull trend that dates all the way back to the February 09 low at 33.55. Interestingly, the 61.8% retrace of the past year's rally from 67.15 up to 114.83 cuts across right about where the market's been supporting thus far for the past few days at 82.42. So we want to be particularly watchful for any kind of bullish divergence in momentum that might, combined with this Fibonacci relationship, warn of at least an interim corrective pop, if not a reversal of the past few months' weakness. It's also important to note the still very bullish sentiment levels accorded this market that we believe can provide an extreme amount of fuel for downside vulnerability. We still have a very high 75% reading in our MRT bullish sentiment index of managed money positions reportable to the CFTC. It has come off, as you can see, but it's still very high, and now that this is putting pain in into those long positions, the fact that the market has fallen off so quickly, we could see quite a capitulation type of environment where this thing really melts down. From a short-term perspective, and watching for any kind of momentum failure that might, at least from an interim standpoint, stem this decline, you can see that by virtue of Friday afternoons and overnights resumption of this past couple of weeks sharp sell-off, the market, we believe, has defined that 88.32 high from Friday as a short-term corrective high and a minimum level this market now is required to recover above to confirm a bullish divergence in short-term momentum. That'd be a far cry from the scale sufficient to expose a much larger degree reversal. It could be the start of such, but at least if the market were to prove strength above 88.32, it will have stemmed this sell-off enough to define and reject some more reliable level of support and a low from which at least interim non-bearish decisions like some short covers or cautious bullish punts can be based. In lieu of strength above at least 88.32, this market is still considered vulnerable to potentially severe losses straight away. And per such, we continue to advise a bearish policy with strength above at least 88.32 required to even defer this bearish view, if not let alone reverse it. Moving to the RBOB market on a daily log scale perspective, you can see the market's recent position at the extreme lower recesses of the past quarter's range. The June 27th low at 267 is absolutely pivotal. In addition to it supporting the market back in June, you can see here on a weekly log scale perspective that immediate area, 266.56 exactly, is a 38.2% retrace of the past year's rally from 178.49 up to 341 double. As long as that low holds, we can continue to argue that the price action down from that May high is a relatively intermediate term bull market correction. If the market breaks below that 267 low, we really don't know how deep the market can collapse thereafter. You can see former resistance, new support prospect from the last May of 2010's 244.11 area, but we similarly have a high degree of bullish sentiment according to the managed money positions reportable to the CFTC at a still very high 89% level. Again, if the market breaks that 267 level, and it looks very heavy right now, we wouldn't want to underestimate the extent to which the market might weaken thereafter. From a shorter term perspective, looking at the 4-hourly chart here, you can see the end of last week's recovery attempt that we think defines the 282.12 high from Friday as the end or upper boundary of a suspected minor fourth wave correction ahead of further losses. And we think that that's as objective a short to intermediate term level the market has provided around which to manage the risk of a bearish policy. Strength above that 282.12 would expose at least the short-term trend is up and provide some more objective evidence for shorter-term traders with tighter risk profiles to move to a neutral sideline position or to at least pair a bearish exposure. But from a longer-term perspective, this market, we believe, is in real trouble, just like the stock market, and it's going to take strength above the $3 level to suggest that this July-August sell-off attempt is part of a much larger degree consolidation pattern between the 267 handle and 341 area. These issues considered, a bearish policy remains advised with strength above at least 282.12 and preferably $3 required to defer or threaten a bearish count. Similarly, looking at a daily log scale chart of the heating oil contract, you can see the clear and present at least intermediate term trend as down. It's nearing the lower recesses of the past 4 months range, where we want to be watchful for any kind of bullish divergence in shorter term momentum that might re-expose another intra-range recovery. Certainly if the market breaks below the late June low at 273.21, this market would be perpetuating a much larger degree peak and reversal threat on a really long-term weekly log scale perspective shown here that would expose or confirm actually a much larger degree correction or reversal of at least the rally from May of 2010's low down at 184.90. You can see, given the relatively uninterrupted nature of the late 2010, first part of 2011 rally, if the market does break that clear low and support at 273.21 from late June, there's not a whole lot below the market to hold it up, and with bullish sentiment, according to our MRT bullish sentiment index, still very high, the market could collapse quite a lot. From a short-term perspective, and similar to the other two markets, you can see the end of last week's recovery attempt to a 296.54 high. Into this sharp sell-off, we think strength above at least that level is required to stem this sell-off, define a more objective low and support, and expose at least an interim corrective pop, if not a larger degree reversal to the past few weeks sell-off. But from a longer-term perspective, I think the market needs to recover above the 305.33 first wave low from last Monday to jeopardize the impulsive integrity of a much broader bearish count. These issues considered, a bearish policy remains advised with strength above at least 296.54 and preferably 305.33 required to defer or threaten a bearish count. And certainly if the market breaks below that June low of 273.21, traders are advised to be watchful for severe, relentless losses thereafter. And finally, looking at the gold market, a market that's clearly been on the receiving end of a quality flight as traders exit most other, with the exception of perhaps the Swiss franc and the U.S. Treasury complex. The gold market seems to be the beneficiary of money coming out of other markets like equities and energies. And you can see that yet again today the market has posted another new all-time high at 1718, reinforcing the secular bull trend. We still believe that the 1608 corrective low from August 1st is the level this market needs to fail below to confirm a bearish divergence on a scale sufficient to expose a larger degree correction or reversal lower. In lieu of such weakness below 1608, further and possibly accelerated gains remain expected. On a shorter term perspective, you can see today's recovery from a minor corrective low from Friday that we believe defines Friday's 1650 spot 30 corrective low as the latest and tightest corrective low and risk parameter. This market is now minimally required to fail below to jeopardize the impulsive integrity of at least the short to intermediate term uptrend and warrant shorter term traders with tighter risk profiles to pair or neutralize bullish exposure. In lieu of weakness below at least 1650 and preferably 1608, full bullish policies remain advised ahead of further and possibly accelerated losses straight away. Please stay tuned to updates on these and other markets on our RJOMRT.com website, and good luck with today's trading.